Hey everyone, and welcome back to the channel. If you or someone you know is juggling student loan debt or planning for college in the coming years, then you absolutely need to hear this. There's a massive piece of legislation making its way through Congress right now, affectionately dubbed the Big Beautiful Bill, and it could shake up the entire federal student loan system as we know it. We're talking about changes that could drastically alter your monthly payments, how long you're in debt, and even who gets to go to certain colleges. Let's get right into what this means for you. This proposed bill, pushed by Republicans, aims for a major overhaul of federal higher education programs. The stated goals are to promote affordability, accountability for institutions, and access to education, all while trying to ease the financial burden on taxpayers who didn't go to college themselves. They're looking to save hundreds of billions of dollars from the federal budget. But what does this mean on the ground for millions of Americans? First up, a huge shift is coming to how you repay your loans. Currently, there are about a dozen different federal repayment plans, but under this new proposal, for anyone taking out federal student loans after July 1, 2026, those options would shrink dramatically to just two choices. You could pick a standard repayment plan with fixed monthly payments, or a new income-based option called the Repayment Assistance Plan, or RAP. The standard plan would change how long you pay. Instead of a fixed 10 years, your repayment period could stretch anywhere from 10 to 25 years, depending on your loan balance. For example, if you owe more than $50,000, you're looking at 15 years of payments. And if it's over $100,000, you could be repaying for 25 years. Now, let's talk about RAP, the proposed income-based plan. Your monthly payments would typically range from 1 to 10% of your income, with higher earners paying a larger share. There would be a minimum monthly payment of $10 for everyone. Sounds simple, right? Here's where it gets complicated. Analysis suggests that many borrowers, especially those with college degrees, could see their monthly bills jump significantly compared to the current SAVE plan. Someone earning around $80,000 a year, which is typical for a bachelor's degree holder, might pay $467 under RAP compared to just $187 under the now blocked SAVE plan. For higher earners, that difference could be hundreds of dollars more each month. This kind of financial strain could delay major life milestones like buying a home, starting a family, or saving for retirement. And the biggest kicker? While current income-driven plans offer forgiveness after 20 or 25 years, RAP wouldn't lead to loan erasure until you've been repaying for a full 30 years. This could mean a significant portion of your adult life spent carrying student debt. Another major change involves eliminating important safety nets for struggling borrowers. Republicans are proposing to get rid of economic hardship and unemployment deferments. These deferments, which have been around for decades, allow federal student loan borrowers to pause their monthly bills during periods of job loss or other financial setbacks, often without interest accruing on their debt. Without these protections, if you suddenly can't afford your payments, you might have very little recourse, potentially pushing many more people into delinquency and ultimately default. The Trump administration itself has estimated that the number of student loan borrowers in default could swell from 5 million to roughly 10 million in the coming months. The bill also introduces new borrowing limits. For undergraduates, there could be a cap of $12,000 per year with a maximum of $56,000 over their entire course of study. Graduate students and those pursuing expensive professional degrees like medicine or law would face even stricter limits. The Senate's proposal includes a $200,000 ceiling on federal student loans for professional degrees. But here's the reality. The median cost for 4 years of medical school for the class of 2025 is far higher, often over $280,000 for public institutions and nearly $400,000 for private schools. This could be a devastating blow, potentially squashing the dreams of low-income and first-generation students aspiring to these professions. It also eliminates Grad Plus loans, which many graduate students rely on to cover living expenses and other non-tuition costs. Critics worry these caps could force students toward riskier private loans, often with higher interest rates and requirements for a cosigner, which many low-income families simply don't have. This could also worsen the ongoing physician shortage across the nation. Beyond individual borrowers, the bill aims to hold colleges more accountable for student outcomes. The House version initially proposed a risk sharing plan where colleges would make annual payments if their former students didn't pay back their loans. This could disproportionately hurt institutions like historically black colleges and universities, which often serve a higher percentage of lower income students who borrow more. The Senate's approach is different, focusing on a do no harm standard. Under their plan, degree programs could lose access to federal student loans if their former students' median earnings are too low for 2 out of 3 consecutive years compared to what a high school graduate typically earns. For example, if undergraduate students from a program aren't earning more than high school graduates in their state 4 years after leaving, that program could lose access to federal loans. While this sounds like a good step for accountability, some experts argue it doesn't adequately account for high debt burdens, only earnings, and it notably excludes accountability for undergraduate certificate programs, which can have very mixed returns. There are also proposals to expand access to technical and trade-based education for low-income students through workforce Pell Grants, offering federal Pell Grant funding for short-term programs. However, concerns have been raised that this could open the door for unaccredited providers and potentially inflate the cost of the Pell program without guaranteeing meaningful earnings boosts for students. It's clear this legislation carries significant weight and has sparked heated debate. While proponents argue it promotes fiscal responsibility and ensures colleges deliver value, critics warn it could lead to an avalanche of student loan defaults, make it extremely hard for people to get out of debt, and limit access to higher education for many. Many experts in higher education finance have offered alternative ideas not included in this bill, such as tripling the Pell Grant to reduce reliance on loans, freezing tuition and fees at colleges, lowering student loan interest rates to incentivize faster repayment, expanding public service loan forgiveness to cover community service hours, creating a dedicated student loan czar in Washington to streamline policies, or even limiting federal funding to colleges until students prove they're unlikely to drop out. These are all ideas currently not part of this specific legislation, but are part of the ongoing conversation around addressing the student debt crisis. This big, beautiful bill is still being debated in Congress, with senators aiming to pass their version, which would then need to be reconciled with the House's bill. It's a complex situation with potential far-reaching consequences for current and future student loan borrowers across America. What do you think about these proposed changes? Let me know in the comments below. And if you found this information helpful, please give this video a like, share it with someone who needs to know, and subscribe for more financial insights. Thanks for watching, and I'll see you in the next one.